Chapter 19, we're going to talk about employers that give employees shares of their stock in a variety of different ways, and then how some of these more complex transactions then can impact our earnings per share computation. So companies that are publicly traded do like to give especially their executive level employees, stock bonuses, stock options, stock appreciation rights, because then it sets the executive levels of the company with the owners. So, like, everybody wants the stock price to go up. So, they're going to make decisions that will positively impact the stock price. Now, from an accounting standpoint, though, we need to value that as compensation because that's basically what it is. It's just another way to get a bonus, just not in cash, but in stocks. So we can have restricted stock plans where there's stock awards and then stock units. So the stock awards is the shares of stock will be in the name of the employee who's receiving it. But if they were to terminate within a certain number of years and not continue on at that employer, they're not going to actually end up getting the shares, and then they're not free to sell those shares during that restrictive period. Then once they vest and they go through, if it's 3 years or 5 years or whatever, then they're going to actually have those shares of stock in their name. So from an accounting standpoint, we're going to put it into restricted stock when we award it to them, and then take it out of that and put it into our regular common stock when they've actually received it or earned it, when it's all vested. The restricted stock units is the right to receive a number of shares of the company's common stock, and it will not be distributed until after they satisfy that vesting requirement. And then, like it says down here, I guess sometimes they could get a cash equivalent. I've never worked at a place that has done that. Most of the places I've worked at, the executives would get stock bonuses that would vest after a certain period of time, and then they would just get that stock. They never got cash options. But so we want to understand our journal entries. So if we have that restricted stock unit plan, at the time that we issue it to those key executives, there is no entry because we haven't issued them any shares of stock. Now, what is going to happen, though, is if we're willing to give them 5 million shares, the current market value is $12. That's a $60 million bonus that we're giving to these key executives. And we're going to charge it out to expense over that vesting period. So in this case, it's 4 years. So that's going to be $15 million per year. So then notice we debit compensation expense for $15 million, again, for each one of those 4 years. And then we credit paid in capital restricted stock. Then when we get to the end of the 4 years and it's fully vested and it can be theirs, we take it out of that paid in capital restricted stock and actually put it into the common stock and paid in capital, which is for our shares outstanding. Now, stock option plans are a more popular way, and like the oil and gas company I worked at, all employees were part of the stock option plan. Our executives were part of that stock bonus plan that we just talked about, where they got the shares of stock maybe vested over 3 years. But all of the employees, no matter what level you were at, got stock options. So every February, and again, the number of shares depended on your position. So if you were a low-level position, maybe you got 100 shares. If you're a supervisor or a manager, maybe you got 500. If you're a vice president, maybe you got 1,000, something like that. So the number of shares indicated kind of what position you were in. But so you would get a number of shares at an exercise price. And for us, it was whatever the market value was on that day. So say February 15th, we did it. What's our closing price on February 15th? And that is our stock option price. And then we would have, it would take 3 years for those stock options to vest. And then you would have 5 years to exercise them. That's how ours worked. So if you're thinking about that, you're like, well, if you got it on February 15th and that's the current market price, you're not getting anything, right? You could go buy those shares at that price. It's not like it's a good deal. But what you're hoping happens is by the time they vest after 3 years, that stock price goes up. So say the current market price is $25 per share, and then 3 years later it goes up to $30 per share. Now I'm in the money. I got $5 per share in the money. And then you'd have 5 years to exercise them. So then it tries to reward employees to also think about the stock price and to say, well, if that stock price goes up, my options go up and I make money. So there is a whole elaborate thing to do this option pricing model. So we had an actual software program that we used at the oil and gas company that we put all this information in, everything that's listed down there below, and then it would spit out what we're going to charge off to compensation expense. So again, it's kind of an elaborate computation. So here they put it into their option pricing model and they get it that it's going to be $8 per option. So then when they issue it, like I said, there's nothing of value when they issue it. We're giving the employees the option to buy the stock price at the exact price that it is. So there's no value on that day. But again, as it goes on over the years, in this example, it's a 4-year vesting period. So we're issuing 10 million options at $8 an option. Again, that put it into your software program and it pops that out. So then $80 million is what we're going to have in compensation expense, and we're going to charge that off to compensation expense each year for those 4 years as they vest, and then we're going to credit paid in capital stock options. Now this one, this example gets a little bit more complex because they change it somewhere along the line. So what they're saying is that they expect 5% of these stock options to be forfeited, which means that people are going to quit. They're not going to make it the 4 years. You know what I mean? Something's going to happen, and they're not ever going to get there. So they estimate 5%. So then we're still doing the same journal entries, but now instead of doing the whole 80 divided by 4, we take it times 95% divided by 4, which that part makes sense. Then this next one, though, it's like then all of a sudden 2 years into it, now they change it. Now they say, okay, wait, more people are quitting or whatever. We think it's going to be 10% of the people that forfeit, or of the shares that get forfeited. So then we have to look at, okay, if we now adjust it to the 10%, and we've got 3 years remaining, our dollar amount would be whatever that calculates out to. And then we're going to subtract out the 2 years we've already taken. So then we are adjusting in year 3 for the fact that now we estimate that it's going to be 10% forfeited. And then we go back though to our, then it's adjusted again a little bit in that 4th year. But I feel like year 3, when we make that decision, that's when we really take the adjustment for those first 2 years, if that makes sense. Okay, then when the stock options are exercised, so it's after 4 years, they're vested, and now the stock price has changed, and what they say is those options are in the money. So then we are going to actually, the employees are going to actually buy them from the company. So the company is going to get cash, and they're going to get it at that $35 option price. Then the current market value, do they give us that in here? I guess they don't. So I guess, and maybe that doesn't matter, because again, we'll just assume they're in the money, they're making the money. So that's why they're exercising them. So then we're going to take it out of our paid in capital stock options where it was sitting as we were expensing it out to compensation expense. Then we take it, so we receive the cash from the employees. We take the $8 value out of that paid in capital, that was the offset of the compensation expense. And then again, now it's new shares of stock. So we credit our common stock at par value, and then the excess goes to paid in capital. So we're issuing them out to the employees. And again, they're paying that option price. And then we're taking what we considered to be the compensation piece out of it, that $8, taking that out by debiting that paid in capital. Then if they expire, we're going to take them out of that paid in capital stock options and then put them into paid in capital expiration of stock options. So they expired without being exercised, which sometimes happens if the market price doesn't go up. People don't want to buy it if it's not a good deal. Okay, whoops, sorry. So then we have stock option plans with performance or market conditions. So they're going to say there must be a specific condition before they're allowed to exercise these options. So it could be like a performance target, or it could be market based, like the price has to go up to a certain dollar amount or something like that. Let's see our example here. Yeah, so if it's based on the market rather than on performance, then compensation is recorded as if there was no target. So that's comparing it again to the one with performance. We'd have to meet the target before they'd have it. And then the compensation expense is charged off whether or not that market condition is met. And then again, it says we're moving away from these in favor of these stock awards and these stock units that we talked about in the first slide. We can also have employee share purchase plans. So the oil and gas company did also have employee share purchase plans, but they were not open to all of us. They were only open to like vice presidents and above. So here it does say, oh, but see, I guess it was maybe, that's the key maybe, is that it was considered compensatory at the oil and gas company that I worked at, because I was not able to participate as a manager, but vice presidents and above. So in order for it to be non-compensatory or non, we don't have to book the expense, all employees can participate in it. And employees have no longer than 1 month after the price is fixed to decide if they're going to participate, and the discount cannot be more than 5%. So then this is saying that we could buy directly from our employer, which saves us having to pay those broker fees as long as that discount is not more than 5%. Okay, so if these criteria for the plan being non-compensatory are met, again, they don't have to record that compensation expense. If the criteria are not met, so like in my example with the oil and gas company, not all employees were eligible, only the higher ups were eligible. So then in that case, that discount would have been considered to be compensation. So then they're going to have the cash coming in from the people who purchased the shares, and then they're going to record the discount at the compensation expense. Now, in this case, their example of it not being met is that they are giving a higher discount. They're giving them 15% and not 5%. So again, I mean, I feel like everybody should kind of understand when a manager's compensation is based on stock or stock options or anything that's tied to the value of the firm's stock, their goal all of a sudden becomes that stock price. And I'll be honest, I saw that very, very much with the oil and gas company. All of the senior vice presidents and the president were hugely concerned about what happened in the stock price. I mean, more so than anything else. I mean, I don't even think they care about earnings unless it impacted the stock price. So because they had so many of their bonuses in the stock, they had, like I said, maybe 1,000 options where I had 100 or something like that. So they're very tied to it. So then that's always a concern that maybe they're going to manipulate numbers, because again, they do not want that stock price to go down. Okay, then the second half of the chapter deals with earnings per share. So our earnings per share is a basic financial ratio that is shown on our income statement. And again, a lot of people look at it. So the basic earnings per share is just our earnings that's available to our common stockholders. So what that means is if we have preferred shareholders and we are paying those dividends, we have to subtract those preferred dividends from our net income. So that's our earnings available to the common stockholders. And then we're going to divide that by our weighted average number of shares outstanding. And then we get an earnings per share. So here again, they're going to give us an example. So their net income is 154 million. They have 60 million shares outstanding. So the earnings per share was the $2.57. Now then this is saying, okay, we can have, if we have new shares that are issued during the year, to do our weighted average, we're going to say, well, we're going to weight them by how long they were outstanding. So in this case, it's 10 out of the 12 months. So then that's going to be a weighted amount to add to our 60. So we would get 70. Now our stock dividends and our stock splits are going to increase our number of shares outstanding. So like when our new shares are bought and sold, that obviously is going to increase the investment in the firm by the shareholders. Money comes in, shares go out. The more shareholders we have, the more people it's splitting into that net income. So our earnings per share starts to go down if we issue new shares. If we have a stock dividend or a stock split, it increases the number of shares so that we have more shares, but they're worth less. So again, like it's using the example, we have the same pie and the same people that own the pie, there's just more slices. So then here we have same scenario, the net income is 154 million. We had 60 million shares at January 1st. And then there was a 10% stock dividend on June 17th. So then we're going to increase those by 10%, which we can do by multiplying by the 110% or 1.1. We issued the new shares in March, at March 1st. So those also got the dividend at the 1.1. So then now our number of shares outstanding goes up and our earnings per share goes down. Now, if we acquire treasury stock, so we reacquire shares of stock, again, either if we retire them or we leave them in our treasury, that's going to reduce our number of shares outstanding. And then that, of course, would increase our earnings per share. So here we have, again, same scenario. So the first part of this formula is the existing 60 shares upped by 10% for the stock dividend, the 12 new shares times the time period that they were outstanding in the year, up for 10%. And then now we reduce it by 8 million shares. But again, factoring in, because it's the weighted average, how long were those not outstanding? And that's just 3 months out of 12. So then that brings our earnings per share up, because again, we have less shares outstanding. Now then we can have preferred stockholders that are going to get their share of our earnings before it comes to the common stockholders. So we have to calculate what those preferred stock dividends are and subtract them out. And like it says here, if they're cumulative, meaning we've got to catch up on any that's in arrears or past due, we will subtract those even if the dividends are not paid that period, because the assumption is they will eventually be paid if they're cumulative. Okay, So now we have, again, same scenario as we did last slide, but now we have preferred dividends. So we have, where does it tell us? I guess off to the side here. So 5 million shares, I guess here in the pink, 5 million shares of 8% preferred stock at $10 par. So then that is, we're going to take our $10 par times our 5 million shares and then multiply that by 8%. And that gives us $4 million in dividends. We're going to subtract those out of our net income, and that is our income distributable to the common shareholders, so the 150,000. And then notice it also decreases our earnings per share. Now then we can have, this is a little more complex of a topic, diluted earnings per share. So the dilution is saying, okay, there are things that are currently outstanding that may end up turning into common stock. So what are those things? So as we look down here, we could have convertible bonds. So when the bonds come due, instead of getting cash, they could choose to get shares of common stock. So that could increase our number of shares outstanding. Convertible preferred stock. So when the preferred stock comes due, instead of getting cash, they could choose to get shares of common stock. So again, it's going to increase our number of shares outstanding, or it could. Same with stock options. If those get in the money and the employees exercise them, it's going to increase our shares outstanding. And then contingently issuable securities, probably not as common, but apparently those can also increase our shares outstanding. So we have to factor that in and calculate a diluted earnings per share. So it's going to show the investors, hey, worst case scenario, all these things come in. What's that going to do to our earnings per share? So options, rights, and warrants. So those are all the ability to purchase stock in the future at a specified price. So the dilution is going to come in like if they possibly are all exercised, and it's going to increase our shares. So we're going to calculate it as if it really happened, as if all of those options, rights, and warrants were actually cashed in, and all of those shares are now going to be outstanding. So here's that same example, but then now we have stock options down here in the pink is what's changed. So we have executive stock options granted in 2019, exercisable after 2023 for 15 million common shares at an exercise price of $20 per share. So our basic earnings per share was what they just filled in at the top. That's the same as before. Now what's changed down here is what's in the pink. So then we have the exercise of the option. So 15 million at $20 divided by $25. So then what they're saying here is the 15, they've upped it for the 10%, the 10% stock dividend. And then the 12 million is subtracted out. So then again, you can see though it drops our earnings per share down because it does increase our earnings, our shares outstanding. So the convertible securities like those bonds or those preferred stocks that could be converted into shares of common stock, when we calculate the diluted earnings per share, we're going to pretend that they were converted. And we're going to do it at the beginning of the period or at a time later if that's what's required. So again, we're going to calculate out what those additional shares would be, and then we will adjust our numerator so that we would no longer be paying those preferred dividends if it's the preferred stock that is converted. And we would adjust our net income for the interest if it's the bonds that are converted. So this one gets a little bit trickier because it's going to impact both parts of the equation. Okay, so we've got the whole same deal up above, but then now we have these 8%, 300 million face amount convertible bonds that are convertible into 12 million shares. So as we look at then our formula, again, the top one stays the same, but now we have 12 million stocks that could be come in from converting these bonds. So that increases our shares outstanding. But then up above here, we're going to take our after-tax interest savings. So the 24%, 24 million, which would have been the 8% times the 300 million of bonds. And then because interest is tax deductible, we'll lose that tax savings. So we're going to subtract that out of it. So we're basically putting the adjustment in net of tax. So then you can see our net income goes up because we no longer have that interest expense, but the shares outstanding also go up. So then our earnings per share is still lower. And then the preferred stock is going to, again, be adjusted on both sides. We will not have our dividends, but then we will have the more shares outstanding. So this preferred stock is convertible into 3 million shares of common stock. And again, they're adjusting it for the stock dividend of 10%. So then notice here, we just no longer subtract the preferred dividends. We take that out, and then we add the additional shares issued for our preferred stock at the bottom. So then the top goes up, but the bottom goes up. So our earnings per share are still lower in the diluted earnings per share than in the basic. And then all of this stuff should be reported in our financial statements so everyone clearly understands how those are calculated. So you'll have a reconciliation inside the notes to the financial statement that shows how the basic earnings per share was calculated, and then how the diluted earnings per share was calculated. And then there is such a thing as anti-dilutive convertible securities, where maybe based on their price, like they would really never be converted. So even though they exist, they're really never going to dilute because no one's ever going to convert at that price. So those are anti-dilutive. So here it shows again, okay, how is our numerator, the top, calculated between the basic earnings per share, then down to the diluted earnings per share, and then what happens to the shares. So that's our basic earnings per share, then down to the diluted earnings per share. So then you're kind of mapping it out to the users so they can see it.